Well, good morning, everyone. My name's Lisa Greenwald. Happy to be making the introduction for today's coffee break. These are our monthly 30-minute sessions on various topics that the Greenwald team is working on and thinking about. Today's topic is near and dear to Greenwald's roots, life insurance, and it is for a few more days, still Life Insurance Awareness Month. So glad that you could all join us. Eric Sondergeld, Managing Director here at Greenwald, is going to be walking us through a variety of topics related to life insurance, ranging from the importance and the uniqueness of the product and protection, some implications and thoughts on, what might impact messaging and education. He's going to tell us a little bit about ways of measuring the life insurance gap and need, and even talk a little bit about a product idea. And these are all things that we do here at Greenwald, helping with awareness studies, measuring the gap, helping with new product ideas. So excited to let Eric take it away, but one or two more quick housekeeping things. If you haven't been on a Greenwald coffee break before, these are small groups. So please feel free to jump in, pop on video, pop off of mute, to ask us questions. I'll also be monitoring the chat if you would rather put a question in that way, and I'll relay it to Eric, and hopefully we'll have a little time for Q&A or discussion at the end as well. But grab your coffee. We hope to keep this brief, but informative and productive. And with that, Eric, please take it away.
Okay, thank you, Lisa, and welcome everybody. And I will try to do what Lisa just promised I would talk about within 20 minutes or less. So I'm going to go through this fairly quickly. As for the topics being covered today, as Lisa mentioned, and not necessarily in this order, the first two will be covered kind of together. I started writing a blog last year, which I've titled Life's Persistent Questions. And some of them are really focused on those questions that have been around forever, particularly those that we need consumers to answer as they decide, whether they need life insurance, how much, what type, et cetera. And those questions still persist. I don't think we've fully found the best ways to answer those questions with or for consumers. So I'll be sharing some thoughts from those. As I do that, I'll be sprinkling in 4 ways that life insurance is unique across all types of insurance products. I'll also spend probably a majority of the time talking about a new model that we've developed for estimating the size of the life insurance coverage gap, and that will lead to concluding with a new product concept. And these icons on the left are what you will see, except for the calculator. You'll know that we're in the model when we're talking about the model. But when you see the question mark, that's a question with life's persistent questions. The bonsai tree there is, I suppose those are unique. And then the idea at the end is the new product concept. So to start, I think it might have been the first blog I wrote, was when is the best time to buy life insurance? And I used this illustration to kind of help guide that. Now, my personal opinion about nearly anything is that the best time to buy it is when you need it. The question, though, with life insurance is that isn't always so obvious. So in this particular example, we have a young man. He starts out in the illustration. He's 24 years old. Maybe he has his first job. He then buys a car but needs to get a loan to finance it. Then he buys a condo with a loan on that. A couple of years later, he gets married. They buy a house. A couple of years later, they start having kids, right? So you could argue that he could buy life insurance at any point throughout this journey, but the amount that he needs and kind of how important the need is changes significantly throughout this time. So there's really no obvious time when he should buy this product. Unlike other products, life insurance is not driven by a singular event, right? There are several events here that are showing his need and the need that those depending upon his income have over time. Unlike things like auto insurance or homeowners insurance, you need those things to actually purchase those items. So I'm not sure we've really figured out exactly when the right time to buy life insurance is. In this case, the right time to buy, if I say when you need it, it could be any time throughout this, right? There's no particular time that says now buy it. Another question is, what type of life insurance should I buy? And that really is the permanent or term question. And I find it interesting that permanent is an adjective, but term is a noun. So we have, noun insurance instead of adjective insurance, but not sure how that happened. But I'm not here to promote either type. They're both great types of products with many different uses. But it also is true that there are deep-seated opinions in this industry, and many people, including companies, are kind of, have maybe a bias in one way or the other. For example, you'll often see term insurance described as temporary insurance, which I find an interesting use of that word, because in my mind, temporary are things that are much more short-lived than, say, 10 to 30 years. If 10 to 30 years were temporary, then I guess, our jobs and we'd be temporary workers living in temporary housing. So I think we still have room to improve the what type question, because we often actually turn that question back to the consumer and say, well, how long do you think you need it? And I don't think most consumers actually know the answer to that question. That's where I think we can do a better job providing them with guidance. But I think another place where this product is unique, it's the only type of insurance that can cover you for your entire life and guaranteed to do so. And then, of course, the question is, well, how much life insurance do I need? Which is not easy to answer, and there are different answers with every single calculator you get out there. Although there are some consistencies in methodology, they pretty much all give different answers, and those answers can vary quite widely. So one is, this question is actually fairly unique to life insurance, right? When you buy health insurance, you're typically choosing from a handful of flavors at your work, and there's no different size policy that you might buy then. Certainly if you're buying, through an exchange and there's a very large number of choices, there might be some different ways you can define, coverage levels and out-of-pockets, et cetera. Even auto insurance and homeowners insurance are primarily based upon the value of the vehicle. And perhaps with auto insurance, yes, you can pick different, liability limits, but within reason, right? There aren't that wide of a set of choices. There is no right answer. As I just mentioned, every tool gives a different answer. So we know there's no right answer. So I think there's room to kind of explore that. But also important is that the answer is valid only for a very short period of time. As we showed in the prior example, their needs change significantly over time. We're going to come back to that a little bit later. But what's also important is that we don't really consider the actual beneficiary's needs very much. They're kind of in the background, but when we look at a calculator, there's no questions about beneficiaries, right? Not a single one. They ask about, what your income is and how many years of coverage you think you need replaced, things like that. So in terms of innovating around this how much question, I think there's new ways to define it. We can innovate around how benefits are paid. We're going to talk about that at the very end. We could build products that have coverage that changes over time because needs change. We could think about coverage that people could buy over time rather than all at once. And we could do more designing for the ultimate user, that beneficiary, which brings me to another unique factor with life insurance. It's the only insurance where the insured or policy owner is not the claimant or beneficiary, and where that claimant or beneficiary is known at the time of purchase. And I challenge anyone to come up with an example that proves this point wrong. So far, no one has been able to. Maybe there is an example. Other than maybe pet insurance. And then also it makes life insurance unique and I think very special. And it's great to remind ourselves of this during Life Insurance Awareness Month, is that life insurance is purchased out of love. I don't know of any other other insurance product that really is purchased out of love, because we're buying it for someone else, not for ourselves. Okay, so let me jump into the model. So the reason I built this model was that there wasn't really a recent model out there. You know, other organizations that have built them haven't updated them in at least 5 or 6 years. And we've created a new life insurance executive forum that exists to find ways to close the life insurance coverage gap. And I wanted to build a new model to help them understand where the biggest places of need are. So the goal was to be as objective as possible, to serve as a benchmark for tracking progress, particularly as that group progresses, and to find out where the need's the greatest, and to distinguish from perceived need, because there's lots of information where consumers will tell you if they think they need more life insurance or not. But this is a more objective approach that I think is also good to have in trying to solve this challenge. And then to develop a set of assumptions that people can agree on. And I tried to be conservative in that. So what this model includes, and it's fairly consistent with traditional needs calculators out there. So it includes income replacement, debt repayment, and final expenses. What it doesn't include are reductions for Social Security, family or survivor benefits, where some other models have. And I decided not to include it for a couple of reasons. One is most calculators actually don't include it. Some do. But I also found an article based upon some research that was done last year that shows that the majority of children eligible for these benefits don't actually receive them. They're not claimed for by surviving parents or others on their behalf. So I don't want to assume that they're getting a benefit that most actually aren't. I also didn't include any assumptions for using life insurance for remaining college funding, and for some of the uses that are often used with some permanent products like estate transfer, charitable giving, etc. So just for the basic needs. So here are the assumptions that I used in the model. I'm using 7 years income replacement, which is less than many recommend. Some recommend 10 years or more. But the model has flexibility in all of these areas. So we could do to a specific age, such as age 65. I'm for the income piece, only including people that might have dependents. So they're either going to be married or partnered or have children. Using an income multiple of 75%, since the benefits are not taxable, we can kind of net out what they otherwise are paying in taxes today, and just using an assumption like 25% there. We are including debt replacement or repayment. We're including $15,000 for final expenses. And one thing to note with this particular model, because we're using the US Survey of Consumer Finances, which is based upon households, not individuals, these gaps and calculations are done at the household level, not the individual level. So we're including $15,000 of final expenses for both spouses. So it's kind of like a combined insurance that household would need. Once we have the full need, we then subtract financial resources that they might have, savings, etc., and any life insurance they also own. So to jump into the actual numbers, here's what the base model looks like. So we start off with income replacement for those who are under age 65 and have potentially dependents, 7 years of their income. We add in debt repayment for those who have debt, and final expenses for pretty much everybody. We get to a total need. Then we subtract out for those individuals, for those households, what their financial assets are, and then any life insurance they own. And some people end up having no need because of that. So we end up with a life insurance gap of $33 trillion in coverage, which is a very big number, representing 83%, 83.5 million of the 131 or so million households, which represents about 64% of households. And what I find really striking about this last number is that, you know, as an industry, we're trying to find who needs more life insurance and how do we engage with them and get them into the purchase funnel. Well, finding them is not so hard, right? You could go to anybody you see out in the world, whether you're shopping or at a child sporting event or something, at the bus stop, with your kids. Chances are that those other adults around you need life insurance because it's almost 2/3 of people or households. If we instead were to say, well, what if we looked at 10 years of income instead of 7, the opportunity jumps up to $50 trillion, and a few more households. Another way to look at this is, what if we, for those who have dependents, had income that just replaced their income for the rest of their expected earning years. I use 65 here. The need just gets huge, right? It's $112 trillion. But there actually is merit in looking at using life insurance to replace income for the rest of your working years. And it's one way of using life insurance to build intergenerational wealth and also define human life value. So there's actually some merit in that method. If we then did income to age 65 for anybody, whether you had dependents or not, you get very huge numbers, 141 trillion. And if instead, going back to the base model, we said, let's not use up all of their savings, because some of that money is retirement savings that the surviving spouse might need to use for their own retirement if this person were to pass away. So if we reduce the resources used to just half of them, the opportunity jumps from 33 to about $40 trillion. So what I want to show you very quickly in these next 6 slides, I'm going to go through these faster than maybe we want to or you'd want me to.
And Eric, I'm going to ask you to pause for a second. We have one question about the debt assumption. Is it assuming a lump sum repayment, or does the life insurance pay the ongoing payments?
That's a great question. So this is all built based upon how the industry operates today, which is pretty much, this is a lump sum world, right? So go back to the assumptions. The debt is paid. It's an assumption for how much debt is remaining that goes into the total. So let's say that you have a situation where the calculator ends up saying you need $500,000 of coverage. Let's say 200,000 of that is debt, just as a number. So by the time that person dies, assuming they die, prematurely, that debt is likely going to be some other number. It's very unlikely it's going to still be $200,000. But there's a $500,000 lump sum now made available to the beneficiaries. It really becomes up to them as to what they do with that money. Right? They could pay off the debt, as was kind of indicated in that initial calculation, or they could continue paying for that debt. Now, it really becomes up to them. Now I'm going to challenge that assumption in just a few minutes, so we'll come back to that again. So hopefully I've answered your question, but I'm going to answer it further later. And now I have to go quickly here. So the way these charts are to be read is the green bars show what the actual total gap is. So that 33.2 on the right-hand side is the total. The blue bars are how many households that represents. So 83.5 million households have a gap. And the purple line shows what percent of households have a gap, and that was the 64% that I showed you. At the below each chart shows what's the average need in those households, right? So this slide is showing that those who actually have insurance, make some insurance already, make up the majority of the gap. Not all of it, but you know, somewhat of a majority, and they tend to have a bigger need. I'm going to roll through these pretty quickly. I believe this will be available afterwards for everyone to see. So the need is highest in terms of percent of households among people essentially in their working years, and then drops off as people get into retirement. The total gap is and the number of households is highest among those kind of in their core working years, millennials and Gen X, and kind of 4 years of family formation, debt, etc. This is a variable they have within the survey of consumer finances that I like a lot. It's called life cycle. So it kind of combines a whole bunch of factors that define whether someone needs life insurance, as it turns out, right? Age, marital or partnership status, and having children. And so you can see it's highest among those that are youngest, that are married or partnered and have children, that middle kind of larger bar, which is 82% at the top. So this is kind of a nice way that combines things. But when you see very high percentages like 92%, 89%, 82% of households needing more life insurance, that's where I think the industry needs to focus rather than just where the biggest dollars amount are. And that really becomes kind of your choice as organizations in the industry is where do you want to focus? Because you could focus on any of these numbers. You could focus on the percentage where the highest percentage need is. You could focus on where the most households are lumped, and you can focus on where the biggest opportunities are, either overall or at the household level. By income, and this is interesting. So the higher the incomes, the higher the total gap. But the lower the income, the more likely they need more coverage and the more households there are. And then by race or ethnicity, we find that certainly the biggest opportunity dollar-wise is with white non-Hispanic households. But in terms of need, it's higher across every non-white ethnicity that we're looking at here, whether we're talking Black or African American, Hispanic, or Asian. And then finally, within the whirlwind of showing you some gap slides, and there's not great information in the survey of consumer finances about whether people have actively have a financial advisor, but there's enough data to show that they have access to or work with someone to help them with their savings and investments, not specifically life insurance. But even here, we see very significant differences that those who do have access are less likely to have a need than those who do, because they probably don't have access to someone who can help them deal with that. So I'm going to jump into the next topic and then conclude so we can have a brief discussion and answer any further questions. So the last life's persistent question that I'm going to cover is, can we make life insurance the income replacement solution it's meant to be? And I say meant to be because income replacement is by far the largest component of the life insurance needs calculation. And in our base model, before we subtract out resources, it represents 3/4 of the amount. We also recommend this income multiple without even explaining why we pick 7 or 10 years. I always thought that was kind of an implicit assumption that, you know, it's just enough time for the survivors to kind of get on their own financial feet. Someone else I know thinks it gives someone enough time to remarry. But also income needs, as we said, change significantly over time, yet we sell people rectangles, right? So in the bottom left is the anatomy of a life insurance policy. It happens to be my prior policy, which I terminated this spring because it reached the end of the term period and the premiums went up by 30 times the original premium. But we sell rectangles, right? So we buy a coverage amount, and that coverage amount stays level for the period of the policy, whether that is a term policy or permanent, other than some permanent policies obviously can increase over time. But the amount quickly gets divorced from the underlying need. Beyond that, current approaches, I believe, have significant double counting in them. So the question about debt repayment, I think, was a great question, because if we're including income replacement in these policies, isn't that income already currently being used to pay for debt, to put money aside for college, retirement, and other things? Yet we add those in as additional amounts into our calculations, and I think that's double counting. And there's a way to actually kind of simplify a lot of this, and that is to make life insurance an income replacement solution by paying the benefits as an income, not a lump sum. And this is from my policy. So it says a death benefit will be paid in one lump sum unless you select a settlement option as described in the payment of proceeds. So the default option is you're going to get a check, right? But if you look further into the policy, and it's not right below as it's showing here, it's on a different page. You have to go down all the way to the third option at the bottom, and so they'll pay it for a period, a specific number of years, or for life. So this type of thing is actually built into most life insurance policies. We have this ability, but we don't leverage it, and it rarely sees the light of day. So what I'm kind of proposing for situations where someone has primarily an income need for life insurance, income replacement need for life insurance, is let's get rid of the word face amount and just talk about income replacement. So what I want to kind of walk through here is, imagine that we could design a life insurance policy that's very similar to disability income. It would be similar in that we'd be paying benefits monthly. The term is expressed in years or to a specific age, in terms of how long that benefit is payable. Inflation protection can be made available. And unlike disability, which actually makes this simpler, is there's no waiting period, right? You don't have to be dead for a certain amount of period for benefits to be payable. And there's no trigger other than time passing in terms of like the benefit period for benefits to end, right? With disability insurance, if you recover from that disability, benefits cease. And here they would just be paid. So it kind of takes away a couple of those complications. Additional benefits of having a product like this is that the death benefit and the intent become much clearer to beneficiaries, right? It's income replacement. It's to replace the income to keep that going because that person isn't around anymore. There's no need for beneficiaries to manage a lump sum anymore. It simplifies the conversation and can be sold along with disability income because of the similarities and the need for income replacement during someone's working years, or it could be built into a combination product. So with that, I'm going to stop talking and ask if there's any more questions. We're a little bit beyond our half an hour.
Well,
Thanks,
Eric,
Sarah. Oh, someone's ready. Please
yeah,
jump in.
yeah. It's Matt again. Thanks for that. So I've been noodling around with this concept myself, and so they're not just the double accounting about the death benefit you want to pay off, but then you're including that in the amount of total expenses. So there's our double accounting there. Something I think about, and I'll just do the stereotypical husband-wife scenario where I always wondered how much of, say, the husband's doing the life insurance needs analysis on himself, or the agent is doing it on the husband. I always thought it would be, I always thought it was kind of, I won't say wrong, but just kind of odd where the wife's financial resources, 401k, Roth, and cash, and the kinds of stuff she has on her own ownership because, it's qualified. I'm not sure that should be included in the resources because she's going to retire. I mean, odds are she's going to retire and she's going to need that for her. So maybe the husband's retirement funds go into his resources, but not the combined. So I don't know if you have some thoughts on that. If
Right, so I think for when you're doing a needs analysis on an individual, you can just include that individuals. And our model, the Survey of Consumer Finances is a fantastic resource, but it's very difficult to split everything by spouse. So like the financial assets, we don't know whose they are. It's very difficult to kind of tease that out. But I agree with you, and that's why I showed that other variation of the model that shows what if you use only a portion of those assets, right? The other thing I think you also hinted at, maybe you didn't, but you could also, particularly with an income life calculation, is if you're replacing someone's income, you don't need all their income, and that's one of the reasons there's that factor of like 75%. But that's usually to account for not having to pay taxes on the benefit. But there's also factors like, well, you don't need to spend money on that individual anymore, right? Because you don't have to feed or clothe or anything or fund that person's retirement anymore. So you could decrease the amount further, particularly from an income replacement perspective, to say, well, how much income is actually being used to support the survivors, and include that. But yeah, there's a lot we could do to improve on and refine that, how we define how much. So I think we just
thank you.
have old thinking that has just kind of continued to this day. But we can probably get a lot more sophisticated with that than we could have, just a few decades ago.
Yeah, agreed. Another question on the amount. So the kids are young, 4 or 5 years old, maybe newborns, and college funding in college is coming, but college is short term, 4 years, 5 years, some people maybe 11. But is the income replacement still going to be the stated dollar amount, like a disability plan? It's a stated dollar amount. This is what you're going to get every single month. But how do you kind of adjust that? Okay, the kids eventually, they're going to have this college funding, and then the cost is going to go away. So that financial need is done, but the person could still die, and there's still some income that needs to be replaced. How does that work within the model?
In the actual needs model?
Yeah,
it doesn't. No, we're just assuming, and that's so I built a model really based upon how the industry works today, not how maybe I think it should, or how it could be improved in some ways. So, I mean, there are products on the market, like Day Forward is an example, that has a product that is essentially used to get families through college. It's essentially a declining term policy that kind of, the death benefit is based upon getting through college, and then it stops. So, but you could if you in defining a like an income life product, you could build in some variability, just like you could build in variability in a changing needs product, even though I'm not aware of any truly changing needs products in this country. There are in other countries, like South Africa. There's a company called Bright Rock that is changing needs policies. So.
Okay, thanks.
So we're over time. Happy to stand if anyone else has questions. We just want to thank you all for coming. I believe we post these as videos on our website in the coming weeks. And thank you for coming. And happy Life Insurance Awareness Month.